Markets under a little bit of pressure today. There are reports that US President Donald Trump is pushing for possible industry-based tariffs, as well as tariffs broadly on countries, and an increased levy on the European Union. He's said to be demanding a minimum tariff of between 15 and 20% in any trade deal with the bloc. There are talks on to try to reach an agreement before Trump's deadline of August 1st. Let's get more from Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, thank you very much for joining us. The market's pretty steady today. Is it tariff fears weighing on stocks?
Well, thanks for having me, Andrew. I don't really believe that to be the case. I think they're looking past that. We've just had a very rapid rise in the market overall, in particular on some of the more concentrated positions within the S&P 500, and that's perhaps just today's trade overall.
Right, because the markets have had this run to record highs and nothing. I suppose Fridays, is it a pattern traditionally in the markets after a really good run? Do people tend to lock in profits before the weekend?
Yeah, it pretty much they're flattening out their book because God only knows what kind of headline news could rattle the market during the weekend. So those type of speculative traders will do that. And that could put some pressure on the markets. In particular, during the summer, it's listless trading overall. Yeah. But, we've seen some rather strong numbers from some of the earnings that have been coming out and, some okay-ish economic indicators as well.
Yeah, that's interesting. I mean, we got decent retail sales for June. Is the market expecting that the U.S. economy will keep chugging along?
Yes, but at a decelerated rate, and that's kind of what you're seeing here. The market, I believe, is starting to factor in a post-tariff world where you have in 2026 and 2029 maybe improved profitability, improved efficiency within the system, and capital spending that could be quite robust here in the United States. That is perhaps one of the reasons why the market's trading at an all-time, or I should say, an extended multiple of 23 times this year.
You have some stock ideas for us. Microsoft, huge in AI. I see Denmark is in the Danes and Novo Nordisk are buying a Microsoft quantum computer to support tech in the Nordic region. But Microsoft appears to have a lot going for it right now.
Yeah, so the reason for owning Microsoft is due in part because not only the AI overlay, but also just the extensive network that they have, which we believe is going to continue, especially on the data service side. This is all a subscription-based type of business. It seems as if through this transition to artificial intelligence, they will pick up incremental revenue growth that will be very durable and consistent. And many companies are now going to look towards Microsoft as a solution for trying to help them and their workload regarding profitability and more efficiency.
Another stock that you reckon looks okay, and it has been an underperformer, Alphabet. Just remind us why investors have been less keen on Alphabet this year.
So since the inception of ChatGPT and the rollout of their AI bot, the major concern is that the major revenue source of search will start to decrease rapidly over the coming years. Search is Google's or Alphabet's bread and butter business. The multiple on this company currently stands at around the 16 times 2027 multiple, with not a lot of growth embedded into it as an expectation. We believe that Google or Alphabet has a full technology stack to compete with ChatGPT. Their divisions like Waymo or their quantum computing division or their Gemini division, all on a standalone basis, could be major contributors of revenue growth. Also, they're shifting more towards search in AI. That too can be a compelling revenue source. For full disclosure, Washington Crossing owns both of these companies, and I do personally own Alphabet in my personal account.
And finally, Clorox, a very different stock, classic staples retailer, bleach and things like that.
Yes, and it's selling at a multi-year low regarding its multiple. We believe that you'll start to see volumes normalize over the course of the next 12 to 18 months, not only for Clorox, but also for the likes of many consumer staple companies. This company is a growing dividend company. Their key problem was that they're still getting over the issues of a hack that has contributed to a dislocation of their customer base. As they incrementally get that back, we believe that the multiple will continue to improve. This company is selling at roughly 30 to 40% from its peer group. So any type of modest tailwind can really gin up the company overall. It has about a 4% dividend yield.